Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. I apologize for being 1 minute late here this morning. I was putting together the slides here, but we have a lot to share with you this morning because there is this fairly sizable internal debate with the markets right now as to the inflationary environment that we are in. Now, this is a big debate because it has a huge ramification on where we position for assets, especially for equity investors that are extremely sensitive right now to interest rates. Last week, we had some pretty big changes. You had May CPI inflationary numbers come out fairly strong in terms of high inflation, yet treasury markets and bond markets reacted kind of in an inverse, I would say, direction to that. And the question still remains, and it's still the big debate, as to whether the inflationary numbers or environment that we're in is transitory or permanent. And depending on which camp you're in, you're going to potentially put your assets into very different investments. So while I don't think we'll be able to settle this debate here today, what I do want to share with you and spend a bit of time going over today is looking at the data, understanding which camps of the market, which sectors of the market feel one way versus another. Hopefully this gives you some confidence or some views as to which way you're leaning, and that will help you determine the type of assets that you might want to put your money into. And we'll give you some both sides so that you can get a sense for whether you think it's transitory or permanent, where you can position your assets in that particular market. So before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So what we're going to do is we're going to start off by taking a look at inflation measures. We're going to look at a bunch of different inflation measures and see how different, just how different they are, and what certain parts of the market is signaling to us, what other parts of the market are signaling effectively the exact opposite. So again, this internal debate from the markets. We'll take a look at how that has affected equity indices and where they're currently trading, which again, largely line up with the bond markets. We'll take a look at some of the bond markets. We'll take a look at commodities and how they're reacting to this. Then we'll take a look at sector rotation model, what sectors are moving higher, what sectors are moving lower. Sector rotation is a bit all over the map here right now, and then share with you a few of our ideas, both on the permanent versus transitory side with respect to inflation. So regardless of which camp you're in, you can get a better sense for how to position your assets. But the primary question that I want to help investors, while I don't think we're going to be able to answer this question on today's call, what we're going to do is we're going to attempt to look at the data to give you a better understanding as to where the market is currently positioned within this debate as to whether the inflation numbers that we're currently seeing is transitory or permanent. So my name is Tony Zhang. I'm the chief strategist here at Options Play, and I want to share with you my technical research, my economic research to help us inform our decisions. So this is largely sparking, this debate is largely sparking because the official inflationary numbers are starting to heat up. So as you can see, this map here, the bluer these numbers, the more the inflationary numbers are showing high levels of inflation. The grayer these numbers are, the less they're showing in terms of inflationary numbers. So the official numbers across the board in May was showing pretty strong inflationary concerns. This is really what raised all the alarm bells. And then what we're trying to determine is to whether this inflationary number is permanent. Because if it's permanent, if we think inflation is going to last for a long time or for a while, that's going to move the Fed. That's going to potentially force the Fed to raise interest rates perhaps sooner than expected. They are likely going to have to taper their bond purchases. They're going to have to raise interest rates sooner than expected. That's going to raise yields, 10-year yields, 2-year yields, 30-year yields. And what that has a negative effect on are equity valuations. When yields rise, equity valuation falls. So there's a lot of concern from equity investors that if inflation is permanent, that the Fed is going to raise interest rates quicker than expected. That's going to cause a downfall, if you will, on the higher beta tech sectors and cause this rotation, if you will, out of the stocks that have performed very well over the past year or so. And then on the other side of the debate, if you believe that this inflationary concern is transitory, that it's just a short-term concern with supply chain shortages, with wage shortages, but that's going to resolve itself largely in the next few months and towards the end of the year. That's going to keep the Fed where they are, low interest rates, and that's going to continue the equity rally that we're on. So depending on which side of the debate you're on, this is going to cause a big shift in terms of how you position within equities. So the question really is, looking at other indicators, can we try to help answer this question? So when we dig a little deeper here, we look at the CPI numbers. What we see is that, first of all, it's not inflationary concerns across the board. There are certain sectors that have seen, or certain parts of the market that have seen extreme inflation, and then other sectors of the markets that have seen some deflation. So, for example, car rentals is one of those extreme measures where, due to the car shortages throughout the year and the pandemic, where car rental companies sold their cars hoping that they'd be able to buy cars back when things are resuming, now cannot purchase cars anymore because there are no cars to purchase due to the chip shortages. That's caused this huge inflation on car rentals. On the flip side of that, you have plenty of other categories like shelter, college, drugs, recreation that have actually seen a decline in terms of pricing. So it's not all even when you're looking at that inflationary number. The bond markets, which is a big indicator of whether the market expects inflation to be permanent or transitory so far, is showing that they're unconvinced that this inflation is here to stay. Pretty much across the board, with the exception of 5-year break even here. The rest of the bond markets do not necessarily see that there's going to be a high amount of inflation going forward. So the markets, the bond markets, one of the largest markets in the world, is somewhat unconvinced that this is a permanent inflation. And many investors will turn to that bond market and say, hey, look at that. The market doesn't think that there's going to be inflation, so I have the confidence that there won't be inflation. So then where is this inflation coming from, or where is this inflation concern coming from? It's mostly coming from businesses. The Michigan expected inflation, Confidence Board expected inflation, NFIB expected inflation, ISM manufacturing and services are all showing across the board fairly, I would say, strong alarm bells that inflation is coming. And inflation, not only is it coming, is it here, and it's likely to last. So that is one of the major parts of the market that is sounding these alarm bells. So what you have here is a pretty large disparity, I would say, between business expectations, and where the bond markets, and largely the bond markets will then affect the equity markets. So there's a large disparity here at the moment. We're going to talk a little bit about what that means for us. Commodities, across the board, we are seeing some inflation across metals, across lumber, across raw materials. I will say metals and lumber, which we'll take a look at some charts here, have come off substantially here over the past few days and even the past couple of weeks. So that is starting to level off a little. So commodity had some strong inflationary numbers starting to pull off here, and wage demand also. Some investors will say the wage concerns are not that big of a concern because the wage inflation is only on the low skilled wages. It's not across the board. If we saw this across the board, that'd be more of a concern. So largely, as you can see, we have this very mixed picture, but there is a large disparity, like I said, between what businesses are saying and what the bond markets are currently pricing in. And that is really where you could see some extreme moves if either one of the markets sort of gets this wrong, if you will. But right now, the equity markets are pricing it off of the bond market expectation. And also economists so far are not sounding these types of alarm bells. So far, the expected inflation rate for 2021 is 2.5% and expected to trend lower here over the next couple of years. So, and if we look at Bank of America's fund survey, where they survey fund managers, 72% of fund managers say right now that they believe that inflation is transitory, and only 23% expect that it's permanent. So you have a pretty sizable gap between the two. So like I said, again, the bond markets are pricing in the fact that inflation is going to be more transitory, meaning the Fed is less likely going to raise interest rates quicker or quicker than expected, and that has caused interest rates to actually tumble below what most investors believed was going to be a floor on interest rates for a while. We've seen this tumble below this 155 basis point level. It's now actually below 150 basis points level. And this has ramifications because if the bond markets are right, then that's going to, the dip we've seen in interest rates will be a tailwind for the equity rally that we started to see materialize here last week. But if, let's say, the bond market is getting this wrong, if, let's say, inflation is a bit more permanent and the Fed potentially has to taper quicker than expected or raise interest rates taper than expected, the fact that bond markets have had such an extreme move to this will likely cause the opposite, snap back, if you will, to the opposite if inflation becomes a little bit more permanent. So the way that the markets have reacted here right now, where interest rates are lower, equity markets are starting to rally, does set up this higher risk, in my opinion. It's not to say that inflation is going to be permanent, but if inflation is a little bit more permanent than the bond markets are pricing in right now, that does put at a higher risk, a snap higher here in interest rates. That's going to put a snap down lower in equities. So that is one thing that I do think equity investors should be aware of and to potentially think about positioning some of the tail risk around this. So when we look at equity markets, the S&P 500 last week managed to break out above this double top around 422 or so, breaking out to new all-time highs here on the S&P 500. We also see it on QQQ, the NASDAQ 100 index, which had been for quite some time lagging behind the S&P 500, making new all-time highs. So we're really seeing technology starting to not only keep up, but actually outperform the S&P 500, something we haven't seen since pretty much the beginning of February. And then you have IWM small caps failing to break out to new all-time highs here. So small caps actually lagging behind the market here right now. And then if we look at the equal weight S&P 500 index, interesting enough that the equal weight S&P 500 has not confirmed a new all-time high. What this is telling us is that the leadership in the current market is narrowing. You have fewer and fewer names at the top that are dragging the markets higher, while the broader 500 names is not breaking to new all-time highs. Now, this is very early in the days of a rally. We very well could see this start to break out to new all-time highs over the next few days and catch up. And if that's the case, things are all okay. But if this continues to diverge, where S&P 500 market cap continues to make all-time highs, but the equal weight fails to make new all-time highs, that's going to be a problem down the line. So keep an eye out here for that. And then what we've seen here is when we said that bond yields declined, was really bond prices starting to climb here. And notice how TLT broke out above this 140 bottoming formation after this strong downtrend. Bottoming formation has now broken out, is coming to retest this level as support, and the question is whether bonds will continue to rally on further evidence that this is going to be more transitory. So like I said, this is really the setup here for the current market. The bond markets have spoken that inflationary is likely to be more transitory. Fund managers seem to agree. Economists seem to agree. The only group of the market that doesn't agree here are businesses. However, this is, in my opinion, the potential setup for what could be a tail event. Now, I'm not saying that tail event is going to happen, but I'm saying if bond markets get this a little bit wrong, where they think it's transitory, but it becomes a little less transitory, more permanent, that's really where you get the snapback sell-off in bonds, rise in yields, and that's going to cause a sell-off here in equity. So those are the dynamics that you need to be aware of and position for in this current market. So when you look at commodities, like I said before, we'll take a look at some of the metals. Copper, we've seen a substantial pullback here in copper back to 435 or so, the support level, this major breakout level so far, holding this level here so far. We'll have to keep an eye out on this. Lumber, substantial decline here in lumber, about 40% decline here over the past month or so. So a lot of the raw materials that have caused this concern of inflation has snapped back here, and that is good, if you will, or confirmation that that this inflationary concern could be more transitory. And this is part of what the bond market is reacting to, the sell-off that we've seen here in commodities. Now, when we look at sector rotation, this is really where sector rotation over the past couple of weeks has really been not particularly strong here. What we continue to see is technology lead higher. We have real estate and energy continuing to move towards the leading category. And then you have materials, financials, staples, industrials moving towards the lagging category. And you do have a few, you have communications that are moving towards the weakening category. You have discretionary that's sort of moving in the leading category, but also at the same time moving towards the weakening category, and utilities moving towards the leading category. So you have a pretty mixed bag here, and there's not a strong, I would say, a thesis as to what's moving here and what's how to position here in this particular sector rotation model here at the moment. But again, we're seeing real estate, technology, discretionary, and utilities being a little bit on the stronger end. And we're going to take a look at some charts to help inform some thoughts here. When you look at the technology side, this is really XLK. We have this double top formed here around 143 or so that we're just pushing this high. If we can break out above this level, this certainly would be a fairly bullish setup here for technology. And when we look at within the technology names, we'll actually take a look at one idea within this particular sector. The question is, where do you position within this sector? Do you position in that high beta growth area, or do you take a look at more quality names? And this is really where I think, depending on your view of whether you believe inflation is more transitory or permanent, that helps answer your question as to whether you lean more towards the higher beta tech growth names, or do you lean more towards quality names. So we'll talk a little bit about that when we get to the ideas section. Another one here is XLY. We talked about XLY because it's starting to move towards that leading category here. And what's interesting here is that on XLY, it looks like originally what was setting up to be a head and shoulders formation is at risk of being broken here and actually invalidated. And we always say that an invalidated head and shoulders pattern is one of the more bullish patterns here. We saw it in technology here last week where QQQ was forming that right shoulder that did not hold and then kept moving higher here, and we saw a very strong move here to the upside. Well, XLY is setting up for the exact same pattern here. You have a failed head and shoulders pattern that's being invalidated. That usually is a fairly bullish pattern back towards the all-time highs here around 180 or so. So XLY, also a category worth paying attention to. And lastly, utilities. After a very strong move here from about $59 to about $67.50, the utilities has started to consolidate for a period of time, whether you want to call it as a flag or a pendant, but is now starting to break out higher here. So this is another very bullish pattern here for utilities. So you have technology, you have discretionary, you have utilities, all setting up from a chart pattern perspective and from a momentum and relative strength perspective, looking fairly strong here at the moment. If you're looking for equity value, positions to move higher in, we're seeing a pretty nice balance here between discretionary, utilities, and technology as potential opportunities for that. So looking at potential trade ideas, one that I want to point out here is still in this current market environment, especially since interest rates are not particularly low anymore. They're no longer in the 50, 60, 70 basis point level. We're now 150 basis point level, and it still has a potential of rising here. I think it's important to position for both value as well as some of the more higher growth names that has the potential of resuming its bullish trend if interest rates remain on the lower end here. But when we look at value, some of the consumer staple names like Pepsi, especially as raw material prices start to come down a little, is at the verge of a major triple top breakout here around $149, $148, $150 zone, if you will. This is a multi-year triple top breakout here. So you have a potential large breakout here on Pepsi. You have the same setup in Coca-Cola, but either one I think are suitable for this particular play where you are at the verge of what looks like a potentially sizable breakout here on consumer staples. And especially commodity prices start to come down, especially as wage prices start to come down a little, this is the potential breakout opportunity for some of these consumer staple names. And we have seen consumer staples weaken, but potentially shifting higher here. So Pepsi, one of the ideas that I want to share with you. On the technology side, this is really where at least my preference is to be more quality, focusing more on quality within technology. Also looking at momentum. We're starting to see Apple pick up on some momentum here. This is starting to break out here above its $128 basing formation. I think this has the potential of rising back up to this 137, 138 resistance level that has struggled multiple times throughout the pandemic recovery cycle, and looking like it can make a run here back at that 137, 138 level. If it breaks out above that level, that really puts it much higher towards 140, 145 or so. So looking within technology, my preference is to look at quality and looking at stocks that have some momentum, and Apple certainly falls into that category. Now, looking at more higher beta tech names, this is really where I think you need to focus a little bit more on the upside, especially if inflationary concerns are more transitory, especially if you believe that the supply chain concerns right now are going to be alleviated relatively soon. Looking for the higher beta tech names, some of the EV players, have a fair amount of potential for two reasons. One, they have completed this bottoming formation. These are stocks that have broken below what I would say post-IPO support levels here. So for a stock like XPeng, and you have the same chart set up in NEO, you have the same chart set up in LI, but breaking below this $37.50 level here, after breaking down below that level, it tested that level twice, failed, traded all the way down to basically what is IPO pricing, and then finally climbed all the way back up, broke out above that level, came back to test this level as support, and is now bouncing higher. So this has, in my opinion, the opportunity to now resume its bullish trend back towards this 55, 57.5 recent highs that it had post the IPO. So if you believe that interest rates are going to stay relatively low, inflation is going to be kept transitory, stepping back into some of these names make some sense, especially when you can line up the technicals with the fundamentals, and especially for those of you that are longer-term investors in a name like XPeng, looking at the autonomous driving technologies, if you will, out of the Chinese EV players. You have NEO, which is the battery swapping technology, more short-term opportunities. XPeng, autonomous driving, more long-term opportunities. Technically speaking, especially if you're looking for a long-term setup, right now looks fairly attractive from a risk to reward ratio. But like I said, this is not focused just on XPeng. You also have the same risk to reward ratio in names like NEO and LI. And simply, it's just that the risk to reward ratio looks far more attractive here. From 42 to 60 versus a stop loss here back into the $32, $33 level. Your risk to reward ratio here is roughly at least about 2 to 1 on that breakout here. And lastly, I do want to position one last example for those of you that are not convinced that the bond markets have it right. Maybe you're convinced that this inflation is more permanent, that the bond markets are getting it wrong, that the businesses have it right. The ways to play that, the ways to play a snapback here is to use some of these names that have really benefited from the inflation, that have now sold off heavily as a result of this pricing that inflation is more transitory, looking for that continuation higher here in names like Caterpillar, Freeport-McMoRan, John Deere. These are the types of names that you might want to look at if you believe that the bond markets have it wrong. And, I'm not here to say that the bond markets have it wrong, but I certainly think that the view that the bond market has is at risk of being wrong. And if the bond markets have it wrong, you are going to see a fairly sizable repricing both in bond prices and in equity valuation. valuations. So for those reasons, those are the ways that I would play this, either by being long some of these caterpillar names or being short some of those higher beta tech names, especially the ones trading at very rich valuations, because those are the ones that will have the biggest correction, if you will, on equity pricing if yields start to rise fairly quickly. And what's going to cause yields to rise fairly quickly? If these inflationary numbers continue in the direction that they're in and they don't come easing off over the next couple of weeks and next couple of months. So with that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding as to this inflationary debate and how to view the numbers around it, how to think about it, and what the risks are, regardless of which side you are on that particular debate. And we will keep you updated here on this debate, if you will, over the next few weeks as we continue to monitor the markets. So with that, thank you so much. I hope you guys have a great trading day, and I'll see you guys next Tuesday.